All right, how we doing? Just gonna try and probably do another short video here, but we'll see how it goes. I'm gonna start the same way as I have done the last few. For those of you who don't know, I don't know what I'm doing. I've got no financial background and I hold no financial qualifications. Basically all this channel is me simply vlogging my educational journey towards, hopefully, fingers crossed, become a successful investor. So everything in this video is for informational purposes only and is definitely not constituting investment advice. Any opinions formed during this video are my own and not recommendations and are subject to change without notice, and please do your own due diligence and consult a licensed financial advisor before making any investment decisions. So that's where we are at. That's me. Don't know what I'm doing. But what I hope to do is, down the line, become a successful investor, and then this could hopefully be used as a lesson for people to see that it can be done, to go from nothing to something, and we'll see how it goes. Now, I was mentioning in the last video that I'm trying to put together a different screener, just to look outside of the USA for a little while. I have, pardon me, I have narrowed down some different stock exchanges, different countries that would be trustworthy in like the auditing and stuff like that. I've basically tiered them, so but I haven't actually put it into a screener yet, so not this video but down the line hopefully we will get into that. I've tiered them between like the most trustworthy stock exchanges, the most, then second most, and then ones that really are, unless you can see that they've been done by a big four auditor, then probably not really worth getting into them. But like I said, we'll get into that down the line. Change the screener up a bit. I was just going to go straight back into the screener, just go down through it. But I just noticed there were a couple businesses on here that I would potentially be, I'm sure I've heard of this one before. And there you go there, almost 1 million. A lot of mail house orders as well, 2.5 million inside of buy-in. It's very slow tonight though, mind. That's not good, is it? It doesn't bode well for the rest of the video. Give me a minute, I'll see if I can sort that out. Right, I'm back. Hopefully sped it up a little bit, but we'll see. Just gonna have a look at this, 2.6 million or 2 million of that is all from a director. That's interesting. CDW. Closing it down, opening it up. It's done this. Look, got up my wrong. CDW. Oh, interesting. They've had quite a come down, haven't they? It might actually be. Is it worth looking into this? Let's put it through the. Oh, pardon me. Let's put it through the quick take spreadsheet and see what it comes up with. Information Technology Solutions operates through 3 segments. Company there. Let's drag that a bit bigger so we can read it. Company offers discrete hardware and software products and services as well as integrated IT solutions. So possibly coming down because it's at risk by AI. Look at that, no downside protect, but then, I was going to say no downside protection from assets, but it's very rare that there isn't a technology company, because some technology companies literally need a room and a couple of computers. Doesn't mean they can't earn the cash flow, so technology is a different, can be a different one from a value investing perspective. I'm sure I've heard Monish Pabrai said he doesn't really invest in technology companies at all, even though like the IT space is where he initially came from. Got good returns on capital, although they've come down a bit. But this here puts me off. It's already at 20 times free EV to free cash flow. That's, I mean, all right, I don't know what the average is for this sector that this is working in. What's it say? It just says technology, so that could cover anything. No, not that. I thought I had a typical. It's just typical ROC, not. I'm sure I'd done it. Maybe I didn't bloody save it. I'm sure I've had one that was typical EV to free cash flow per industry. It's not going to be too hard to do that. You could just ask AI to come up with it. I'm not going to do it now, but effectively 20 years to pay back the enterprise value of the company from earnings, which is not something I'm overly interested in, to be honest. Oh, I don't know. 70%, that's high though, isn't it? You know, even on free cash flow, the return on capital. We look into this or not? This is just majorly putting me off. 20 times earnings, like, I think I'm just gonna pass, to be honest. And what's in the news on it? Just the fact he's purchased 2 million shares. I mean, it's big, isn't it? It's almost difficult to ignore a purchase like that. Who holds it? Let's have a look. Is it worth going into? Is that which one it is? CDW Corp. Yeah. Oh, fucking hell. What a twat. Back to this. Drag that over there. That's going to fuck me off now, though, because I want them the other way around. I ain't got a clue how to move them. Gonna drag it over there. No. So. Reverse views. There we go. Oh, back to where I wanted it to be. I'd just bug the crap out of me otherwise, because I'm so used to looking at it this way round. So biggest percent of portfolio is 5.4%. It's not very high. Not high. I mean, for some people it's high. For me, it's not. It's not very. Not a lot of conviction in it for me. A lot of the investors I follow or that I admire are very concentrated, and that is sort of how I want to be. At the moment, I only currently hold 4 positions. They're all doing all right, to be honest, as well. But early days yet. There's not enough conviction in that to me. I think I'm just going to pass on it. What was the next one? Granite Ridge Resources on it. Little and often. Yeah, little and often. There's a lot though, isn't there? It's just constantly buys. I'm sure I've heard of these. Whether or not I've looked, I must have looked into them before, because I've got a. There's not a lot of data mine, historical data. Let's have a look. GRNT. So, pretty good downside, providing these assets are correct, but pretty good downside. Negative simple free cash flow. Here we go. This is probably why I said no to it then. Have I got it? I've got a tracker here. Let's have a look in this tracker. GRNT. No, I've not wrote about it. So I've obviously just historically passed on it. Probably because of the negative free cash flows, and they're going the wrong way as well. Look. They've always been negative. Very good, is it? Must be quite a speculative thing then, is it? Negative free cash flow constantly. CC GRNT. Just have a look at the balance sheet. If they're not earning anything, which they aren't, depletion and accretion, yeah. So what that is if, as they pump it out, obviously the oil or the gas field gets less valuable because there's less in it, and I think that is what that is. Could be wrong, but I lost onto. Interest expense. Not doing very well, are they? What's on the cash flows? Why do they keep getting so much cash then? Is it all borrowing? CapEx, yeah, higher than the core. No, that's 3 months. Alright, we'll probably pass on this. Anything else worth looking at? Goosehead Insurance. I'm not really interested in looking at other people's funds. RLI Corporation. They do. Insurance and underwriting, another insurer. What's that, COVID? Yeah. Tell you what, they took off from COVID, didn't they? Right, let's have a look. What's the bloody ratio you got to look for in insurance combined ratio? It's not loaded. Tangible book value $17. 5 times EV to. Oh, pardon me. 5 times EV to free cash flow, mind. Simple free cash flow. This is just a quick look. It's not a not my actual spreadsheet. I got a much more in-depth spreadsheet, but this is a quick look to see whether or not it's worth bringing in into the main spreadsheet. Is it? Isn't it? What's the market cap? 5 times. What has it traded at? Down. This, no, hang on. Yeah, but this one here, look. If you look at this number, it tells you whatever period, what the historical. Actually, we bring it up. Store pane. There you go. You can see like an average maybe through there, or in recent years, it's dropped right off. What we say the average is across that 13 times free cash flow. That's not saying it can get back to it, by the way. Not at all. It's difficult to even. Revenues have gone up. So what's it trading at 5 times now? Is it worth just looking into this? Say it was making 300,000. 300. This is literally, I'm just pulling numbers out of the area, by the way. But it went back to 13 times. That'd basically be worth around about what it is now. So can it stick at 500 million at free cash flow? Is it worth looking into? God, I can't stop yawning. It's my last day on shift today, so I tell you what, the heat on shift in the last week or so has been brutal. So it's probably time. Yeah, we're going to do it. We're just going to pass on it, I think. That was at RLI Corp, wasn't it? Yeah. Access Newswire. What else is huge? Goosehead Insurance, another one. GSHD. Another insurer. Another one. Probably won't land with anyone outside of Britain. Most people in Britain know that saying. Just a bit of technical analysis here. Look, a long historical, the price is around a historical low that is what got 6 years worth of validation now. Historically, huge moves away from it as well, from this area. Put it in the spreadsheet. Depends on what I guess it depends on what they insure towards the cyclicality of it. No tangible book. And their enterprise value, so they've got a lot of probably acquisitions, goodwill and intangibles. Have I got it on here? Not according to this, they haven't. Why the hell's tangible book so negative then? The problem is I haven't got a total lie. I said I was going to do that, didn't I? I haven't fucking done it. Just put a couple more things in here. Like actual book value as opposed to tangible book value, so I can see all the differences, and then you can sort of estimate where it comes from. But just from this, I can't tell what book value is because I haven't put the data in this. I would have thought it comes from. Must have a lot of debt. That's a lot as well. Mine's 17 times earnings. That's a no. Instant pass on that. What was it? What's it trading at now? They're saying 17 times earnings, although I got it at 13 times earnings. Historically, should I keep this pane open? I don't know. Historically, fuck off. Really? Historically, 46 times earnings, 37 times earnings. That is fucking shit crazy. You'd want to buy a company that would take you 47 years to. I ain't even going to be around in 47 years or 37 years, let alone bloody hoping that I get a payoff from a company, finally turn a profit on my investment. Alright, Blackstone Minerals, over $1 million. I think it could be interesting. BSM. Oof. Tell you what, if you call it down here, you can road it all the way up to 20. But they do exploration company, exploration of oil and gas. So we're going to see negative free cash flows on this. No, positives. 13 times earnings. What's going on here then? Why is this taking a... Oh, that's difficult as well. Why don't you get an average across that? Historical average maybe there, 8 times earnings. We're already above it. Not earnings, free cash flow. My biggest problem is that it's gonna... Some of these videos might end up being incredibly boring because I'm literally trying to say no as fast as I can so I don't waste the time on it. Roaring Kitty in a lot of his videos used to say that as a standalone investor you need to be fast because there's so much stuff to look through. William Marsh Rice University. interesting. 39% of his portfolio. I mean, he's confident, isn't he? Who owns the most outright ownership here? Doesn't say. Okay. Go back to the portfolio one then. Percent of portfolio. That's a lot of. What was his estimated average purchase price? 17. What is it now? 13. I mean, I would like to have bought it down here, wouldn't we all? This is obviously that it went from. There you go. This is what I'm looking at. This is the sort of thing I like. This 2 to 3 times earnings. People say it doesn't happen, but it has happened. No, it's in. That's in COVID. Even then, though, after that, it's been ages down. Ages. What would you be up like 50% even if you waited a year after COVID? 46%. Is it worth looking into? What else was on here? Tangible book. I still think I'm going to say no. I just think 13 times. When we've already determined it's probably above the historical average. 7, 8 times. I need to get that fucking average industry EV to free cash off. Have I got a different document maybe? Hang on. I went back again. Oh, there you go. Comparison metrics. No, okay. Not the document I was thinking of. I'm looking at stuff off screen in a minute, but it doesn't matter because I can't find it. I definitely put a document together which showing all that stuff. I will have to find it because very useful. But I can't remember if it was a Word document or an Excel document anyway. We haven't really done anything in this fucking video yet, have we? Let's start going down through the screener maybe. Rent. Oh dear, that's not very good, is it? What do they do? Ready to wear and contemporary designer apparel, okay. Does not seem to be in favour. Negative free cash flow all the way throughout. Total debt of 200 million as well. How are they paying that? Oh yeah, something's happened. Gone down. Let's have a look. CC. Rent. So the last statement was 10k. Who audited it? PricewaterhouseCoopers. What am I looking for again? What did I like? Well, there's a lot I don't like. Oh, the debt. I want to see what's happened with the debt. It's literally halved. How has that happened? Financing. Right, hang on then. Detailed notes. Where is debt? Liquidity. Is it going to be under there? Liquidity, maybe. Leases. Long-term debt. Narrative. No, not in there. Hang on then. Let's pull it up. It's much easier to search the notes this way, I found anyway. Oh, hang on. They just. Oh, fuck off. Press the wrong thing. Oh, I haven't got that either. Ugh. I guess there are a couple more things I'm going to have to put in the quick take spreadsheet, I think. Because I don't know. Have they done something by. Have they like issued more shares and they've done it that way? Right, what's this company called? Go to the cover sheet. Let's ask AI, see if we can find it quicker. Upstairs a minute, I can hear someone banging around. But have negative free cash flow. What has happened? See if it can find out for me. If you're not using AI to help you, it's this trick. Dramatically cut, so restructured it. A company announced a transformative deal with lenders, investors led by Limited via debt to equity exchange. Lenders received a controlling majority stake in the company. Yeah, that's what's happened. I thought it was. When it drops down and there's no cash thing, it's got to have happened some way. Remaining debt was reduced to 120 million. Company ramped up inventory spending, supporting accelerating revenue growth, customer acquisition. Free cash flow is negative. Yeah, we've seen that. Driven primarily by these CapEx inventory builds, operating cash flow is modestly positive, but investing outflows made free cash flow worse. One-time capitalization cost also weighed on free cash flows. Problem is, free cash flow has been consistently negative. Literally the whole way. Operating income, negative the whole way. So that means that just the costs before, that's not net income, that's operating income. So revenue minus costs has always been negative. This is a no. Rent is a no. What was there? And negative, so they haven't even got any assets. So no, they could be in serious trouble if shit don't pick up. Revenue has slowly climbed, but not for me. Straight no. BYD. What's that? Boyd Gaming Corporation. I thought it was a fucking Chinese car firm then. That's already quite high. What's this? 52. It's 0 to 10% above. It's 52-week low. Low 1 month. Within the last month, it has been 0 to 10% between its 52-week low. But it still looks quite high, doesn't it, historically? Cool, look at that. Imagine if you'd got in here. What happened here? Trading 60, 70 times. I wouldn't have even held for that. That is ludicrous. That is ludicrous. Oh, Paul, BYD is going to bring up the right one. Boyd Gaming Corp. It's a bad tangible book. High as hell EV to free cash flow. I'm going to have to go upstairs a minute. I think one of the children's up. It sounded like someone was coming through the roof and yet everyone's up there fast asleep. If you haven't got kids, I tell you what, when you get them, watch how much they move around in their sleep. It's nuts. Put them to bed the right way up and you get there like a couple hours later, check on them before you go to sleep and they're down the bottom of the bed and upside down or on the floor or bloody all over the place. So historic. So I've got an average as well. Maybe I should pay more credence to the average. I got that in bold. I went away upstairs to see the kids, and everyone was fast asleep. But I come back down, and the bloody audio went, and as you can see, I've gone through a few different companies since then as well, so that's quite annoying. I said no to BYD. What have I got in the main spreadsheet at the moment? SGU. Okay, so that's further down. This video is not going to be a lot shorter because I'm going to just bash through quickly the bits that I have done on the other one. So I said no to BYD. Why did I say no to BYD? I can't remember now. I think it was just on the multiple. The multiple was too high. There wasn't much downside from that perspective. Casinos as well. But, you know, simple free cash flow down. Yeah, I just wasn't interested. So this one annoyed the shit out of me. I'll show you why. This is a land firm. So sort of to do with coffee. Why is that not working? I've done this page there as well. Oh, that's why I wrote nap instead of NAP. So what really fucked me off about this is this. The absolute sheer lack of breakdown in the operating cash flows and the activities. So you would think, oh, hang on a minute, this is a huge improvement. And actually, it's not even in the, you know, revenue's gone through the roof, and there's no breakdown of what's actually happened and what has happened. If we go to this one here, basically they sold some land, and that is the only reason why it went through the roof. So not interested in that. Focus on land ownership and real estate. Historically generated low erratic revenues, owns thousands of acres, relies on periodic property monetization. So that's what's happened. So there's no, you know, real turnaround in the business. They've literally just sold some land, and it's not broken down anywhere, really. So didn't like that. Didn't like NAP. SGU. So heat and oil, propane related services. Now this one, I thought, you know, might not be too bad. So I've got this one in a spreadsheet. You can see it right here. Revenues are all right. They were higher, but they're not too bad. Gross margin's gone up last 3 years on the 3-year average. So that's pretty good. Simple free cash flow margin's down a little bit compared to what it was, but it's not too bad. Equity's going in the right direction, at least over the last few years. So you had negative tangible book to positive tangible book. Now I don't like the fact that the tangible book is so small compared to the current price. So that's put me off. $56.50 in revenue though, per share, which is considerably high compared to what we got here. Simple free cash flow though has taken quite a hit, which I didn't like. This, if you look into it, it's all from working capital. Let's pull up the conversation, because I had a conversation about it. Basically, it's all in working capital. They're saying seasonal build up, revenue, in inventories, receivables surge, customers buy fuel, prepaid balances decline. So cash flow use of 61.1 million driven by increase in receivables, inventories, other assets. Now, if we actually look at the, where does it say down here? Right, it's largely timing and seasonal items rather than operational problems. Cash flow improves post heating season as inventories are drawn down, receivables collected and credit balances rebuild. Now, if we actually go on the quarterly statements here, you can check that it is seasonal here. Look, straight away, winter months, Q1, Q2, the revenues are considerably bigger than what they are to Q3, Q4, because obviously that's the summer months ones. So the vast majority of their business is done in these two quarters here. Now, when you go back through here, you've actually got a really nice long-term average of price to free cash flow here, and it really goes from at the bottom of this, maybe 4 to 7, 8 times free cash flow, but the historical average has always been around about this level. You don't find many businesses where the average is that clear, really. So if we say that it normally historically trades between 4 to 8 times earnings, historically, they're saying it's a potentially a one-off on the simple free cash flow, so we'd take it as the word. Don't necessarily entirely believe in it, but revenues have gone up and margins have improved. Operating margins actually improved as well. So the average over the last 7 years of simple free cash flow down here is 76 million. So say on average 76 million, right? And we know the average is 4 to 8 times earnings. So I'm a value investor, so I'm going to go the most conservative route possible. Now, that would be 4 times earnings, and we know that the average over the last 7 years is 76 million. So 76 million times 4 is 300. So say, all right, that seems a little bit low because it can go up to 8. So we'll say 76 million times 5, 380 million. Well, currently it's trading at 412 million in the market cap. So based on that, it's slightly overvalued. 8 is the absolute highest, isn't it? So I would never choose that. But that'd be 600 million. So there's potential. That would give potential, not financial advice, but that figuratively would give potential for a 50% upside. But as a value investor, I don't do that. I always go on the lowest possible one. And if we're saying 4 to 5 times, around about on an average of 76 million simple free cash flows, 380 million, it's currently 412. So I was out on that thesis. Not that it's much of a thesis, but I was out on that. But it could be one to keep an eye on because cyclical. There's some quite large swings in price as well, and I do like the consistency in the price to free cash flow average. That is impressive to me. So SGU is not something I'm interested in now, but it is something that I might look at in the future based on that. The next thing that I was going to look at was this VRRM, but I can't currently get Grok to look into it. But this fallen off a cliff here, and if we look at this, here we go, Vera Mobility, won't do it, it's just not answering the question, but fallen off an absolute cliff, literally down 65% on news of this look. So they've lost Avis Budget Group, decided not to renew their contract. An accountant, so this is where we're going to look into this in the next video. So this video, I'm afraid, is super short because fucking half of my audio disappeared, but it is what it is. We've basically covered everything that I was covering in it anyway, but in a much, much shorter time span, which might be more interesting for people. Who knows? But the Avis Budget Group decided not to renew a contract, but that accounted for, say, more than 10%. So 10-15% doesn't give a precise figure, but 10-15% of revenues have gone, which is not killer, is it? It's not great, but it's not killer. But the stock has acted like the baby's been thrown out with the bathwater. 10% of the revenues, and you've lost 65% of the value. This is prime area for potential finding of something. So in the next video, that's what I'm going to do. We'll go through it, we'll see, because at the moment I can't get Grok to work, and it's 1 o'clock in the morning here, so I can't really be bothered to go through it and figure it all out, because my brain's just not working. I'm just too tired at the moment. So if I can't get the AI assistants, we'll do it in the next video, which is what I promised we would do, because two things have happened here. They've either admitted that it's massively overvalued, or they've just thrown the baby out with the bathwater. So definitely be worth looking into, I would say. Anyway, you've only lost 10% of the revenues, but you've absolutely demolished the stock price. So we'll see. We'll go into it on the next video. That is a definite, and I will try to get this video up ASAP. Now it's like bloody 20 minutes shorter than what it was meant to be. I should be able to get it up a lot faster, and then hopefully before the weekend, because it is the weekend now. This is Friday. Well, it's not a Saturday morning now, 1 o'clock Saturday morning. I've got the rest of the weekend now to try and look through this before Monday, and I will try and do it, and hopefully try and get a video up maybe for you on Monday. Definitely could be something interesting going on here. Like I said, I reiterate, it's dropped 71% to a record low after losing only 10% of revenue. So we'll look into it and we'll see what happens. Sorry the video's so short, but I promise you did not want to listen to the poor audio quality. Something happened, I don't know, just ended up really distorted. Shit happens. So you basically missed out another 20 minutes of me breaking down the stocks that I just went through in the space of like 5 minutes anyway. So, you know, there we go. I'll see you on the next one. Please like and subscribe, and we will definitely get into this one hopefully before, hopefully I'll be able to get the video up Monday morning, hopefully, for this. So I will try my hardest to look into it, and we'll try and go deep on it and figure out what's gone on. 10% of revenue, 76% of the stock price. I said, not great, is it? But there could be a huge opportunity there. So we'll see. Thank you very much. Please like and subscribe, and I will see you on the next one. Good night.